your trusted partner for business and residency in Lithuania.
Welcome back to Global Pathways. I'm Maya, and today we're discussing something we're seeing more and more in Lithuania. Foreign business owners are no longer just starting companies from scratch. They're acquiring existing Lithuanian businesses. And not small experiments. Real operating businesses with revenue, staff, and tax history. To explain why this trend is accelerating, I'm joined by Tom from Pathways.lt. Tom, welcome.
Thanks, Maya. This shift is very real. Over the last year especially, we've seen a strong increase in investors choosing acquisition over startup formation.
Let's start with the big question. Why are foreign investors choosing to buy existing businesses instead of starting new ones?
Because history equals credibility. When you acquire an existing Lithuanian company, you're buying operating revenue tax records, local employees' compliance history, and business credibility. For immigration, banking, and long-term residency, that history matters. A startup begins with zero. An existing company already has proof.
Let's talk about a real example. Recently, you helped acquire a sushi business in Vilnius. What happened there?
Yes, that was a great example of how this works properly. The business was a sushi restaurant in Vilnius generating around €20,000 per month in revenue. It had 2 local employees and was compliant with tax requirements. The monthly net profit was over €1,500. The total acquisition price was €28,000. 2 shareholders acquired the business, each invested €14,000 and held the required ownership structure. Because the business was already active, operating and employing local staff, it fully satisfied the immigration department's requirements for residency by investment. Both investors applied for temporary residence permits, and both received their TRPs within 15 days.
15 days is fast.
Very fast, but that's what happens when the structure is correct and the business is real.
You also helped with an acquisition in the construction sector.
Yes, in that case, the investor acquired 33% of a construction tools trading company. The investment was €50,000. The company was 8 years old, with annual turnover exceeding €900,000. That kind of history significantly strengthens the residency application. The investor secured his TRP, relocated to Lithuania, and we supported him through the entire process with our legal and financial advisors. When you enter an established business with proven turnover, the immigration department sees substance, not risk.
And then there was a much larger deal.
Yes, we had an investor expanding his portfolio who acquired a manufacturing company in Lithuania for €1.5 million. In that case, we secured a 5% stake in the transaction and structured a full management solution. Our legal team, financial advisors, and head management team are now supporting and overseeing the business on behalf of the investor. This is a different scale, but the principle is the same. Real operations, real management, real economic contribution.
Let's talk openly. Does the Department of Immigration look more favorably at investors buying existing businesses?
In practice, yes. When you invest in a real operating company, the business already pays taxes, it already employs local staff, it already has revenue, it already contributes to the Lithuanian economy that reduces perceived immigration risk. It's not about favoritism, it's about economic substance. If you invest into a startup, your first visa is usually a national visa. If you acquire an existing business that meets requirements, you can receive a TRP for up to 2 years from the start. That's a significant difference.
So the structure of the visa itself changes depending on how you invest.
Exactly. Startup route, typically a national visa first. Acquisition of an operating business. Temporary residence permit for up to 2 years. That means longer stability, faster integration, clearer residency status, stronger banking profile. For serious investors, this matters.
So why are we seeing more investors choose this path now?
Because investors are becoming smarter. They understand that time is money, immigration stability matters, banking credibility matters, existing revenue reduces risk. Lithuania has a strong base of small and medium-sized businesses whose owners are open to exit. For foreign investors, that creates opportunity.
Who should consider buying an existing Lithuanian business?
This approach works best for entrepreneurs wanting faster TRP approval, investors seeking real EU presence, portfolio builders expanding into Europe, people who prefer buying revenue instead of building from zero. It's not for someone looking for a passive paper investment. This is active ownership, even if management is delegated.
If you had to summarize the advantage of acquiring an existing business in Lithuania, what would it be?
Credibility. A real company with revenue, staff, and tax history makes everything smoother. Immigration, banking, residency, long-term expansion. Lithuania rewards real economic activity. If you're serious about EU residency and business, acquisition can be the smartest entry point.
Tom, thank you for sharing these real cases. To our listeners, if you're considering residency by investment in Lithuania, think beyond startups. Sometimes the smartest move is stepping into something that already works. This is Global Pathways by Pathways.lt. Until next time, stay strategic.